Welcome to another video by the Option School. This is your friend Pradeep Singla. In this video, we'll be talking about one of the most flexible option strategy which you might not be using because it's not very popular. The name of the strategy is ratio spreads. Why ratio spreads? Because in volatile markets, ratio spread is such a tool which takes care of most of the volatile moves of the market. Now, ratio spreads can be put ratio spreads can be call ratio spreads also, but we will be talking about call ratio spreads only. Now, let us explore why I am saying only call ratio spreads and we are totally ignoring put ratio spreads. As the saying goes, stock markets typically collapse like a pack of cards swiftly while falling, whereas whenever up move is there, up moves are generally slow and methodical. So any strategy which protects me from downfalls which are fast and which gives me money even if market is going up can be a very good strategy. So call ratio spreads provide a very good space for slow up move of the market and there is no issue in the fall of the market. In fact, it removes all the risks for any furious or wild down move of the market and even in the sideways market it is pretty much safe. Let us now try to understand how to construct the call ratio spread. As the name suggests, there will be a ratio. So we will be buying one call and selling two calls. So that becomes 1:2 ratio call spread. If we buy one call and sell three calls of higher strike, then it becomes 1:3 ratio spread. Once we see how the ratio spread is created, we will also see the payoff diagram. We will also see the different zones in the payoff diagram, and then we will see what has happened in the few previous months through backtesting. Let us say we have purchased a call for rupees 100 and then we have sold two calls. Obviously these two calls will be of higher strike and we have sold these two calls at rupees 60 each. Now what we have done, we have paid rupees 100 to the market by buying a call and we have received 60 into 2, that is 120 rupees, by selling two calls of 60 rupees each. So paid 100 and received 120 rupees. So this gives me net 20 rupees, 120 minus 100 as a credit to me. So my net credit is 20 rupees in this trade. Few changes can definitely be made in this trade, but we are just taking a simple example. So in case we sell calls which are having higher premium, obviously the net credit available will increase, and in case we sell calls with the lower premium, the net credit available will be smaller. If we see payoff diagram, it will be something like this. Now this payoff diagram has three zones. First is no loss zone. So if market falls to any levels, there will be no loss. We will be making that 20 rupees, the credit which we have taken. Second is this triangular portion which is max profit zone. So if market expires within this triangular zone, it will be giving us maximum profit which can be huge. But if market crosses that triangle, it goes to a danger zone which is red. Now this is very interesting slide. Here I have taken three different call ratio spreads. In the first example, what we have done, we have purchased one in the money call and we have sold two out of the money calls. In the second example, what we have done, we have purchased one at the money call almost and then sold two OTM calls. In the third example, we have purchased OTM call and sold two further OTM calls. What I want to show is that in this case the risk is on the upside, and if I can get same kind of a credit by shifting my whole ratio spread on the upside, that makes a lot of sense, because downside in any case there is no risk, all the risk is on the upside. So it is always better create a ratio spread which is very far away. So even if there is a market, even if there is a big market move, we are not at all getting trapped in the danger zone. That is the big trick in this. Let us check now on the Greek's part of call ratio spreads. In this case, if we see net theta is positive, which means with time we will be accumulating decay and accumulating profits. And other part which is important is Vega is negative. which means in case implied volatility falls after creating the trade, it will be profitable, and which also means that we should be creating these trades whenever implied volatility is high, so that from higher implied volatility it goes to lower implied volatility and gives more profit to us. Next obvious question is it risk free? No, not at all. It's not risk free. We have already seen that there is a danger zone in the payoff diagram also. Although it's not risk free, but risk is manageable. It is very important in options trading whenever we are trading any strategies that whatever risk we are taking, either that risk is whether that risk is blind or whether that risk is manageable. In this case, as we have seen, downside there is no risk, sideways market there is no risk, only one portion wherein if market wildly moves up there is a risk, and that risk is also manageable because it will give lot of space and time for the trader to manage that risk. Also, as we have seen, major portion of the trade is not having any risk at all. Also, the probability of profit is quite high, which I am saying based on previous backtesting data. Also, I'm going to share a few months of backtesting data with you in the last. So, which shows that okay, most of the time, that either the trade gives you profit or it gives you space and time to adjust the trade. So, that becomes a very good framework for any kind of markets. Now, let us see what are the margin requirements for ratio spread. In case of Nifty, if we are doing 1 is to 2 ratio spread, which means we are buying one call, we are selling two calls, the margin required is roughly around 1.5 lakhs, and expected profits can be 1 to 1.5%. For ratio spread of 1 is to 3, the margin requirement will be approximately around 2.7 lakhs. So whenever we increase the ratio, obviously the margin requirement will increase. Again, expected profit in this case also is 1 to 2%. Whether it's a good profit, whether it's a bad profit, that I leave to your understanding. Now let us see some backtesting results. So what we have done, that we have created the trade on the first of the month, and then we have seen what has happened at the end of the month without any adjustments, and what is the time when 1% return is achieved in the trade. So in July, 1% return is achieved by in 9 days only, by 9 July, but end of the month it has given us more than that, which is around 1.6%. In August, it took it 14 days to achieve 1%. End of the month is better. In September, it took it 22 days to achieve 1%, but ultimately in the month it has given us around 1.3%. So good 3 months for this strategy for July, August, and September. October month definitely was challenging because both the things were bad, rising wicks and market becoming unidirectional. So within first 8 days, it entered the profit zone, max profit zone, and hence there was an adjustment required. After doing the adjustment, again the trade went into good profit of 1.77% at the end of the month. Now this is slightly tricky. What kind of adjustments we can do? Let us quickly go through that. So one of the best adjustments in this case when market enters into the third zone, danger zone, is convert the whole trade into broken wing butterfly or butterfly depending on where is the market. This step converts the trade into a profitable trade, or maybe sometimes it can be a small loss trade. So that's what we mean by when we say risk is managed. We will talk about more such adjustments in our upcoming videos in detail. Please feel free to write to us for any doubts in the comment section, and do like and subscribe the channel. Meet you in the next video. All the best. Bye.